What if I told you that the mutual fund sitting in your 401k right now is quietly stealing about $430,000 from your retirement? Not through some elaborate scam, not through fraud, but through something perfectly legal that nobody bothers to explain to you. See, last week I got an email from a 35-year-old teacher named Sarah. She'd been diligently putting money into her retirement account for 12 years. 12 years. And when she finally looked at the fine print, really looked at it, she discovered she'd paid over $23,000 in fees for a fund that didn't even beat the market. Now here's what really gets me. Sarah's smart. She's educated. She did everything right. And yet she was losing a fortune without even knowing it. If that sounds familiar, well, you're not alone. And today, we're going to fix that. Here's what most people don't realize about investing. The financial industry has spent billions of dollars convincing you that investing is complicated, that you need experts, that you need actively managed funds with smart people in suits making smart decisions with your money. And you know what? It's one of the most profitable lies ever told. Let me give you a number that should make you angry. According to a 2023 S&P Dow Jones study, over a 15-year period, 92% of actively managed large-cap funds failed to beat the S&P 5 index. 92%. Think about that for a moment. 9 out of 10 professional fund managers, people who went to prestigious schools, who spend 60 hours a week analyzing companies, who have teams of researchers, can't beat a simple index fund that just owns a piece of everything and does nothing. Nothing except make you wealthy. Now you might be thinking, but Warren, surely the funds that do beat the market are worth the extra fees, right? And that's exactly the trap. Because here's the thing about human psychology. We're wired to believe that expensive equals better, that complexity equals sophistication, that someone actively doing something must be better than just doing nothing. I've seen this play out for over 60 years. People would rather pay someone 1.5% annually to actively manage their money than pay 0.04% for an index fund. Why? Because it feels like they're getting something. But let me show you what you're actually getting. Let's say you invest $10,000 today. Over 30 years in a simple S&P 500 index fund with average historical returns of about 10% annually and fees of 0.04%, you'd end up with approximately $170,000. That same $10,000 in an actively managed fund charging 1.5% in fees? You'd end up with about $116,000. That's a $57,000 difference on a single $10,000 investment. That's not a rounding error. That's a new car. That's a year of college tuition. That's your retirement dreams walking out the door. So what exactly is an index fund, and why does it work so beautifully? Think of the stock market like a big basket containing pieces of America's largest companies: Apple, Microsoft, Amazon, Johnson & Johnson, hundreds more. An index fund simply says, I'm going to own a little piece of this entire basket. That's it. No trying to pick winners, no betting on hot stocks, no genius required. When you buy a share of an S&P 500 index fund, you're buying a tiny slice of 500 of the largest companies in America. When these companies profit, you profit. When the American economy grows, you grow with it. And here's where it gets really interesting. Because an index fund isn't trying to beat the market, it barely needs to trade. No buying and selling, no capital gains taxes eating into your returns, no fund manager salaries, no expensive research teams. The result? Fees that are often 30 to 40 times lower than actively managed funds. John Bogle, the fellow who invented the first index fund back in 1976, used to say that in investing, you get what you don't pay for. Costs matter, and boy, do they ever matter. Let me paint you a picture with real numbers, because this is where most people's eyes start opening. Imagine you're 25 years old. You decide to invest 500 every month until you're 65. That's 40 years of consistent investing, 240,000 of your own money going in. In an S&P 500 index fund at historical returns with minimal fees, that becomes approximately 3.2 million by retirement. In an actively managed fund with typical fees and slightly lower returns, that becomes about 2.1 million. The fees alone cost you over $1 million. $1 million that could have been yours, just gone, evaporated. And for what? For the privilege of underperforming? This is what keeps me up at night, because this isn't theoretical. This is happening right now to millions of hardworking people who are doing everything they're supposed to do. Saving consistently, thinking long-term, trusting the system. Now, I can almost hear what you're thinking. Warren, this sounds too simple. Shouldn't I be doing something more active, more sophisticated? And that's the psychological shift we need to make. We've been conditioned to believe that more action equals better results. But in investing, the opposite is often true. Let me tell you a little story. In 2008, I made a bet with a hedge fund manager, $1 million bet. I said that a simple S&P 500 index fund would outperform a collection of hedge funds, supposedly the smartest money managers in the world, over 10 years. Know what happened? The index fund returned 125.8%. The hedge funds? 36.3%. It wasn't even close. The hedge fund managers were brilliant people. They worked incredibly hard. They used complex strategies. And they lost by an enormous margin to a fund that just sat there and did nothing except own America's biggest companies. Here's the truth that nobody in the financial industry wants you to understand. Simplicity works. Boring works. Cheap works. So how do you actually do this? How do you start investing in index funds? First, you need a brokerage account. Vanguard, Fidelity, Charles Schwab. These are all solid choices. Most let you open an account with nothing and start investing with as little as $1. Second, you choose your index fund. For most people starting out, a simple S&P 500 index fund is perfect. At Vanguard, that's VOO or VFIAX. At Fidelity, it's FXAIX. At Schwab, it's SWPPX. The specific letters don't matter. They all do basically the same thing. Look for two things: broad diversification and rock bottom fees. You want an expense ratio below 0.1%, anything higher, and you're paying too much. Third, and this is crucial, you automate it. Set up automatic investments every month. Whether it's $50 or $500 or $5,000, it doesn't matter. The magic is in the consistency and the time. Because here's something most people miss. The real power of index fund investing isn't just the low fees. It's the psychology it creates. When you own an index fund, you're not tempted to trade. You're not checking stock prices every day. You're not trying to time the market. You're just being patient. And patient money is powerful money. Think of it like planting an oak tree. You don't dig it up every week to see how the roots are doing. You plant it, you water it consistently, and you let time do its work. 20 years later, you have something magnificent. Now, I want to address something important. Index funds aren't glamorous. Nobody's going to be impressed at a dinner party when you tell them your investment strategy. There's no excitement, no story about the hot stock you picked that tripled, but you know what is impressive? Reaching your retirement goals, having financial security, not lying awake at night worrying about money. The financial services industry has built a $500 billion business, convincing people that investing is complicated, that it requires experts, that ordinary folks need professional help, and certainly there's a place for financial advice on comprehensive planning. But for the core of your investing, you don't need them. You never did. A simple index fund, consistent contributions, and patience. That's the formula. It's not sexy. It's not complicated, but it's made more ordinary people wealthy than any other investment strategy in history. Here's my challenge to you. Go look at your retirement account right now. Really look at it. Check those expense ratios. See what you're paying in fees. Run the numbers on what those fees will cost you over 30 years. I promise you, you'll be shocked. And then ask yourself, is this actively managed fund really worth what it's costing me? Because in all likelihood, the answer is no. Sarah, that teacher I mentioned at the beginning, she moved her retirement savings to low-cost index funds 3 months ago. She's already sleeping better, not because her returns are suddenly through the roof, but because she finally understands where her money is going, and more importantly, where it's staying. Look, investing doesn't have to be complicated. In fact, it probably shouldn't be. The best investment strategy is usually the one you'll actually stick with. And there's nothing more stickable than something that's simple, cheap, and proven to work. Your future self, the one retiring comfortably in 30 or 40 years, will thank you for making this decision today. Now go look at those fees. Your retirement depends on it.